Stocks are down, freight is leaking up, and oil just got dragged right back into the spotlight. So, if you've been waiting for the market to give you a clean signal, yeah, this might be one of those weeks where the clues are finally lining up. And the funny part? They're coming from three totally different places: beaten up tech, boring old materials data, and a geopolitical headline that can move your gas bill before your coffee even cools. I'm Vanessa, and if you like your money news with a little edge and a lot of actual usefulness, you're in the right place. I break down what matters, what doesn't, and where regular investors can get caught off guard. Because right now, the market is doing that classic thing where one part is trying to recover, another part is quietly improving, and another part is one headline away from chaos. Cute, right? Let's start with the one a lot of investors are staring at, like, okay, are these finally the bargains I've been waiting for? Three high-growth stocks are down about 25%. And the case being made is simple. If the 2026 tech rebound shows up, these names could snap back hard. That's the setup. But here's the real question. Are these just cheaper stocks, or are they actually mispriced opportunities before momentum returns? That distinction matters a lot more than people think. A stock being down 25% does not automatically make it a deal. Sometimes it's a discount, sometimes it's a warning label. But in tech, especially in the high-growth corner of the market, the biggest gains often come from buying before sentiment turns, not after. Everybody on social media suddenly decides the same stock is back. That's the open loop here. If the rebound happens, the upside can be fast. If it doesn't, you're sitting on a name that can keep testing your patience. What should Americans take from that? Pretty simple. If you're investing for the next 5 to 10 years, not the next 5 minutes, this is where watching revenue growth, margins, and whether a company still has a real competitive edge matters way more than the daily chart drama. A lot of people look at a 25% drop and think cheap. The smarter move is asking, did the business get cheaper, or did the story break? That's the difference between buying a future winner and catching a falling knife with a smile. And honestly, this is where the market gets a little spicy. Because tech rebounds don't usually start with everybody feeling comfortable. They usually start when the crowd is still skeptical, still underweight, still saying, I'll wait for confirmation. Then suddenly the move is already happening. So if you've been sitting on the sidelines waiting for the perfect green light, the uncomfortable truth is that the best entry often looks boring, ugly, and a little lonely. That's not glamorous. It is, however, very profitable when you're right. But let's pivot to something that sounds way less sexy, but may tell us more about the real economy than a lot of flashy stock talk. Freight demand is getting a fresh read, because the two materials that help predict it both just posted gains in February. And before your eyes glaze over, stay with me, because this is where the numbers start telling on the economy. Why do these materials matter? Because freight doesn't move in a vacuum. If more goods are being produced, shipped, and restocked, that shows up in the supply chain. And when the materials tied to freight demand improve, it can hint that shipping activity is picking up underneath the surface. Not a parade, not a victory lap, just a better pulse. That matters for Americans in very real ways. Freight demand is tied to the stuff you buy, the stuff your business sells, and the costs that get passed along in between. If freight is strengthening, that can mean inventory is moving, industrial activity is holding up, and parts of the economy are less fragile than people assume. It can also matter for jobs. Trucking, logistics, warehousing, ports, manufacturing, all of that is connected. When freight improves, it doesn't just help companies. It can ripple into wages, pricing, and the overall temperature of the economy. But here's the catch, and this is the part people miss. 1 month of gains does not equal a trend. It's a clue, not a conclusion. So the move here isn't to overreact. It's to watch whether the improvement continues. If it does, that could support a healthier outlook for industrials, transport stocks, and parts of the economy that have been waiting for demand to show up with a little more consistency. And if you're an investor, this is actually useful because it gives you a different lens on the market than just staring at the NASDAQ all day. Tech can be recovering while freight is strengthening. That's not a contradiction. That's a market trying to broaden out. And when breadth improves, that's when the story gets more interesting. Not guaranteed, just interesting. Big difference. Okay, now for the part that can make everything above feel very academic very fast. Oil risk is back in focus. Dow futures are set to open with oil futures in the mix, and the market is watching tensions around the Strait of Hormuz after comments from President Trump suggesting Iran could be in hell if the waterway isn't opened, while also leaving the door open to a deal. That is the kind of headline traders do not ignore. Why does this matter to you if you're not trading crude futures at 2 a.m. like a maniac? Because the Strait of Hormuz is one of the most important energy choke points in the world. If that route gets threatened, oil markets react fast. And when oil reacts, Americans feel it in very unglamorous places. Gas prices, shipping costs, airline tickets, inflation expectations, and eventually even consumer spending. That's the chain reaction. Here's the market psychology to watch. When oil risk rises, investors often start rotating. Energy names can catch a bid, transportation stocks can get pressured, broader indexes can wobble if inflation fears heat back up. And if inflation gets sticky again, the whole conversation about rates, valuations, and who deserves a premium multiple gets messy real fast. So yes, this is geopolitical news, but it is also portfolio news, and the timing matters. The market just rebounded last week after a rough stretch, which means sentiment is still fragile. That's the open loop inside this story. Will the rebound keep going if oil spikes, or will one geopolitical scare slam the brakes? If you've ever wondered why stocks can rally one week and get slapped the next, this is exactly the kind of headline that explains it. The market loves stability. Oil risk is the opposite of stability. So what should you do with all three stories together? First, don't treat this like one isolated headline cycle. These are three separate signals, but they point to the same bigger theme. The market is looking for direction. Dayton-down tech is trying to set up a rebound. Freight data is hinting at underlying economic activity. And oil risk is reminding everyone that inflation and volatility are never really dead, just sleeping. Second, for your own money, this is a good moment to separate quality from noise. If you're looking at high-growth stocks, ask whether the business can actually grow into a recovery. If you're watching the economy, look beyond GDP headlines and pay attention to shipping, materials, and logistics data. And if oil starts moving hard, remember that the impact can spread faster than people expect. Your portfolio doesn't need you to predict every twist. It needs you to notice the pressure points before everybody else does. Third, this is exactly why diversification still matters, even when everyone is obsessed with one theme. Tech can rebound, freight can improve, and oil can spike all in the same week. That's not confusing. That's the market. The people who get burned are usually the ones who think one narrative has to explain everything. It doesn't. So here's the bottom line. The 25% drawdowns in high-growth tech could be setting up opportunity if the 2026 rebound actually gains traction. Freight data is quietly flashing a better read on demand, which could tell us more about the real economy than a lot of people want to admit. And the oil story is the reminder that one geopolitical headline can still change the mood, the inflation outlook, and the direction of the market before lunch. If you're investing right now, the move is not panic. The move is precision. Watch for the rebound, watch for confirmation in freight, and watch oil like it pays your bills. Because in a way, it kinda does. And if the market gives us one more twist this week, oh, trust me, I'll be back with the part everybody else misses.